Welcome to Wine and Real Estate, the podcast where we drink wine, we have fun, and we learn about real estate investing. Real estate investing is so much more than just buying buildings. It's about building relationships, building your dreams, building your dream lifestyle, customizing your life. What do you want to do? What do you want to achieve? It's much more than money. It's more than getting rich. It's a different type of wealth. It's the wealth of time, the wealth of freedom. And now let's get to the wine and the real estate. Let's start this episode with some financing tips from our go-to mortgage broker, Streetwise Mortgages. Over to you, Dalia.
Hi, I'm Dalia, founder of Streetwise Mortgages, and in today's episode, I will go over what I refer to as the tip of the iceberg. When it comes to mortgage financing, we all want a great interest rate. I have seen investors make their financing decision purely based on the interest rate alone, and that's not the right way to go. The interest rate alone is what I call the tip of the iceberg. The fine print associated with the rate, as well as the potential adverse implications for your future portfolio financing of going with a lender that is offering a low rate but may not be the right lender for your portfolio, are what I refer to as the iceberg itself, which is what you need to pay attention to. Here are the things that may be hidden beneath the rate offer that you need to evaluate. Number one, ability to break the mortgage. Some low rate mortgage options are fully closed and can only be paid out if you sell the property or refinance with the current lender. Even if you want to pay the penalty to switch to another lender, under a fully closed mortgage, you won't be able to. I have seen variable rates that fall in that category as well, so do not assume that all variable rates are breakable with a 3-month interest penalty. Under a situation where the mortgage is fully closed and where the client no longer qualifies with the lender due to a change in their finances or the lender's guidelines, the client will not be able to take out equity with the current lender, nor be able to move to another lender unless they take on a private mortgage in a second position. This is not a good situation to be in. Number two is prepayment options. If you wish to accelerate the mortgage pay down on a property, you should pay attention to the prepayment options that allow you to top up the regular payments or make a lump sum annually. Some products allow you to go as far as doubling up your monthly payment and paying 25% of the mortgage on an annual basis. The lowest rate mortgage options typically have restrictions on how much you can top up your payment or pay down the mortgage annually. Number three is amortization. Many lenders would discount the rate on a shorter amortization. For example, the rate on a 25-year AM would be cheaper than a 30-year AM. For real estate investors, I suggest taking an extended amortization, and here are the reasons why. Number one, your monthly payment would be lower, and that will definitely enhance your cash flow. Number two, you can always cut down the effective amortization down to 25 years, even if you go with the 30 years initially, through managing the prepayment options. Number three, interest is tax deductible. And finally, a longer amortization would improve your borrowing power for your next deal due to the lower monthly payment. The fourth and last point is that going with a lender who offers the lowest rate does not mean that the deal is financed with the lender who is right for your portfolio. Each lender has a cap on the number of properties they will finance for you. And if you exhaust that cap unintentionally through financing purely based on the rate versus choosing the lender who is right for your portfolio, you will hit a financing wall down the road where you will have to inject a higher down payment or pay for higher financing costs in terms of interest and fees. To help you navigate the rate environment as well as the best mortgage options available to you as an investor to grow your portfolio, email our team at info@streetwisemortgages.com. Cheers to your success.
Welcome. So Anthony Scandariato from New Jersey. Anthony is the co-founder and managing principal at Red Knight Properties, which is a privately held boutique multifamily and mixed-use real estate investment and property management company with a track record of building and managing portfolios that deliver dependable cash flow and equity upside. They have over 650 units in 4 different US states and over 70 million in assets under management. So Anthony, welcome.
Yes, thank you for having me.
My pleasure. So, wow, 70 million in assets, 650 units. I coach a lot of people in how to become real estate investors, and they always ask me, how should I get started? So there's the answer: get 650 units. Seriously, how did you kind of grow from there? I'm sure it's a bit incremental. And
Really appreciate you having me on. And yeah, it doesn't start out with 650 units. It starts out much smaller. Well, make a long story short, a little bit about my background. I actually ended up working for a real estate operator in 2014, basically to 2020. So I spent,
okay,
so I spent 6 years there and got to learn everything about the business that I could, everything from acquisitions to asset management to property management to due diligence to negotiating loan terms, raising capital, pretty much everything I wanted to see I saw and got involved with. So I had a great run there, and basically all my salary when I worked there, I devoted it to investing part-time into my own deals. And I really loved multifamily. We were investing in office products, so a little bit different, but concept is still similar in
yeah,
generating passive income. So basically, I ended up buying. The way I started was a 2-family property. I still own it to this day in the States, in New Jersey, and it was actually in the same town I grew up in. So I ended up buying that property, fixed it up a little bit. Had to evict both of the tenants, and then basically got new tenants in there, and then I just get cash flow. All my money's out of the deal just from cash flow. So to me, that's just annuity at this point. And I started out with that, and then I saw some minor success there. So I bought another 2-family with the partner that we basically fixed and flipped in the States
okay,
as well, in New Jersey. And then ended up buying a 10-unit property in the States with my now business partner, Brian Leonard. I got introduced to him. He was a former NFL player, and I got introduced to him through a colleague of mine at the company I worked for. And we really hit it off. And he was in his early 30s when he retired from the NFL. And
yeah, it's a rough sport.
yeah, it's a rough sport. He didn't really want to do it anymore. He get 2 herniated discs. So,
Oh yeah,
but he was still young and he still wanted to be active. So he met me and he saw what I was doing on the side and was like, "Well, I have some capital, I have some time. Why don't we try to do some larger deals?" So we did that. We bought our first 10-unit together. This was in 2018. That we basically doubled the value of the building. We refinanced. We pulled our initial capital out, and then we bought something else, and it kind of springboarded from there. So it basically went from the 2s to a bunch of 10s. We bought about 70 units together between 2018 and 2019. And then in 2020, like very early 2020, we started looking at 50. We closed on a 50-unit building in New Jersey as well. So all local markets to us, obviously, and bought that. And that was our first larger deal. And our first deal where we brought in outside, partners and investors. So it was a $5 million purchase in, the States here, and we needed about 1.5 million to close on it. So we ended up just raising that through friends and family and our network. And we really like that business model because it allows us to do bigger deals and scale, and it's more efficient at the management level because we self-manage our
yeah,
properties. So basically went from that 50 unit. We did well. We executed on our business plan there. We were able to refinance in April of 2021. Everybody got their money back plus profits. So we put that in another deal. So it kind of from there, that was the trajectory. So it basically went from that 50, and then we bought a bunch of units in 2020 as well as in 2021. So it did take time. It wasn't, at the snap of your fingers like that.
no, and that's a lot of work. I mean, even if $5 million, raising the $1.5 million for the, I guess, the down payment, and what sort of due diligence do you need to do Like in Canada, it's quite common when you get into 10 units and up, or 6 and up. Sometimes there's environmental assessments, phase 1, phase 2. Is that something that is done in the US as well?
Yeah, absolutely. We do. We know part of the we have a checklist, and we have like 50 things that we look out for. We don't always get those 50 things, but it's
No.
still a checklist to look at for guidance. We do. Usually, the lender requires property condition reports, phase 1 assessment, sometimes phase 2. Thankfully, we haven't
Yeah,
needed to
hopefully
have that.
not, but sometimes.
Yeah. Phase 1s, appraisals. We look at all the financials, historical financials and whatnot. Usually that process takes about, we usually have about 30 days to do our due diligence. We've been becoming quicker at due diligence because the markets have changed and it's very hyper competitive. So
Yeah,
sometimes you need to put down hard earnest money before you even go on the contract, especially in very hot demand states like Florida right now, where we're invested in, just like
it's
yourself.
insane over there.
It's insane, and it's not going to stop over there, in my opinion. So, very business friendly environment, and so sometimes we have to step up, but we're able to kind of skim down that list a little bit and make sure we're getting exactly what we need to feel comfortable with some of the terms that some sellers are asking for. So, it all depends upon the market, and if it's a seller's market at the time or a buyer's market, the pendulum always swings. So that's essentially what we look, some of the items we look for.
Okay. And how do you structure your deals? I'm curious. So it sounds a bit like syndication. Do you charge an acquisition fee to the group, or how do you work normally on a
Yeah,
deal?
it is a syndication. Usually I'm the general partner with my partner, and obviously we're overseeing the day to day. We, find the deal, we secure the financing, we do all the due diligence, we property manage. So yeah, there is obviously some fees associated with it, but that's basically charged to the group, and whatever we charge, in terms of acquisition fee. Let's say it's $100,000 in US dollars, right?
Yeah.
For finding the deal. Let's say that's 1% of the total deal size. And usually what we'll do is whatever the acquisition fee that we'll get, we'll put that in the actual deal. We're not just going to take it and just go to town with the money. We usually
Yeah.
put it in the property. Plus we'll invest at least double on top of that. So if it's 100, we'll put in at least 200.
Okay.
So that's a little bit how it works, but essentially it's about combining resources and then we split the profits together in that model.
Yeah, it's a lovely model to help out others that are not ready to make that jump into becoming landlords or owners. They don't know the due diligence process, or they have smaller amounts. Like, do you have a threshold? Like, I have a few friends that do syndication. They say like under 50K, they don't even want to hear about it, or 100, or what's kind of your threshold normally?
Yeah, the 50K US is pretty much what we like to target to. There's been a little bit less for some younger people who want to get
Yeah.
involved that I know or whatever, I help them out. Maybe it's 35, but if for it to be worth it for anybody, at least the 50 is a great starting point, and it's not going to break the bank. I've seen some deals that are 250 for minimums. I've
Yes.
seen some really high ones before. Maybe I should change mine, but at least it's good. It's good to kind of cater towards a almost younger professional that has a high paying W-2, and they have they have disposable cash, and they're wanting to invest it rather than spend it. And that's going to do a long way, because if you buy one deal, I had one guy, he put in 50,000. He was able to buy like probably 4 deals with just that 50,000 because we
Yeah.
turned over the money.
Recycle, and he keeps his share, even though the
Yep,
money's out. So it's the Burr strategy, but on a
exactly.
larger scale.
Yep.
That's great. So you're really cultivating those relationships as well. So if I were you, I would not change to the 250K, because
Yeah.
those smaller people will end up with the 250 and 500,000,
Yes.
because you're helping them get there. So this is
Yeah.
really good. And you mentioned family, friends, networking. What kind of networking do you do? Like, is there an investor group in New Jersey, or a few of them? Or-
Yeah, and again, we invest in different. We're in 4 different states right now, so New Jersey, New York, Pennsylvania, and Florida.
Okay.
And I've had experience in other states too, not with my company, but for my prior company, Carolinas. Um, so, what we usually do is we have a podcast too. It's called Discovering Multifamily, and
Yes.
you'll see, you were on it before, so
Yeah, and
um,
listened to a few episodes. Very interesting, very different, and it's interesting to hear about the U.S. market and how it varies and all that.
yeah. So we do have a lot of, we do have an educational component. We do meetups, so usually we have them in, where I am, New Jersey, New York City. We try to do those once a month, just networking, strictly networking
Oh,
meetups.
but it's your own meetup. Okay, that's cool.
So we do a combination of virtual and in person. And there's a bunch of different real estate networking groups, and like you said, friends and family. Once you start, once your name is getting out there and you start to provide good returns for your investors, they'll tell their brother, they'll tell their
Oh
sister, they'll tell
yeah.
their cousin. I can't tell you how many people have brought their parents in the deals now.
Wow.
They're like, hey, can my mom invest 50 grand? I'm like, I guess. Um, so it just comes to if you're performing and you do what you say you're going to do, or not only do that but under promise and over deliver, then you're going to have some happy investors at the end of the day.
So what kind of return are you providing? Do you have an average? It's fairly recent. I mean, 2018. You've been
Yep.
doing it for about 3 years.
Yep.
Is it 10%? Like, what are we looking at? Or
Yeah, I mean, we like to target a 15% internal rate of return at the end of a
okay,
5-year period. Um, that's our target. We've been able to beat that on, I don't know, probably like probably 5 or 6 times already, very quickly, because there's been some, refinancing events that were above the basis of the
yeah,
investors, so they actually got paid more. So they don't have to wait till the end to get their IRRs, which is very, very good for us. Um, and they're still reaping cash flow benefits as well. So we like to target the 15% type of return at the end of the day. But in the cases, it's been a lot higher. I mean, one of them was 40%. Another one was like 35. So it's,
wow,
I never like to say that, because then I'm looked at as I don't know what
yeah,
I'm talking about. And I still don't know everything, but if someone came to me and said, hey, I'll give you a 40% return on your investment, and I would just tell them, go find somebody else to scam, because
yeah.
that's
Sounds
not fair.
fake.
Yeah.
So you're mentioning Pennsylvania. I'm not very familiar with Pennsylvania. Where are the opportunities? Are there like hotspot cities or towns or?
Yeah, and to put it in context, we're investing in middle market deals, so anything between $5 and $20 million in the U.S.,
Okay.
where it's 50 to 200 unit properties that we're usually targeting. Pennsylvania is, kind of on the outskirts of New Jersey, New York metropolitan area, so it's just further west. A
Yeah.
lot of the assets we bought are in Western New Jersey, so why not just go a little bit more west?
Oh, okay. It's very close by. Cool.
Yeah. So we have the scale and efficiencies that kind of coincide with each other there. And there's some areas that have been very untapped in Pennsylvania. And then obviously we have the areas in Florida too, which has been booming. Um, so we're continuing to expand in Florida too, in certain markets, because some markets I think have peaked, and then some
Yeah.
not yet. So we built up a good team in all 4 states, so we'll continue to invest there, and hopefully we'll find some other good states too as well.
And do you just self-manage or do you manage for others the properties or?
We self-manage just for us. We thought
Okay.
about managing for others, but it kind of loses our focus a little bit
Yeah, it's hard.
in the business. Yeah, and it's not. I'm not saying it's not worth it and that I wouldn't consider it. It's just it's hard, like you said, and it's you're almost being a little bit disloyal, I think, to your investors for managing other people's properties. You
Yeah.
should just manage your own and make sure yours are performing for yourself and your investors.
Yeah, and it's not a super lucrative business too. There's a lot of expenses, permits, insurance, and all kinds of things to deal with. So it's a good service to offer your investors, like you said, rather than hire out. They get the money faster. I'm sure, like your rent roll, since you manage it, it's not sitting for 10, 15, 20 days, depending on the company. before you get it. So
Yeah.
cool. So for 2022, have you set some goals for yourselves and the company, or what's
Yeah, I mean,
next?
we have some high level goals. We're in some of the cycles of our deals where we might consider selling a couple, and we have a few deals. We have a couple deals under contract for first quarter of 2022 to close. I'll be bringing out to my network soon.
Great.
So we have that, and then usually I kind of look at it on a quarter by quarter basis. We like to do one new deal a quarter. It's going to be a little bit different this time because we're actually probably going to sell a couple of assets. So we'll see what ends up happening with the deal flow. But usually, if we're going to sell something and there's investors involved, we'll try to line something up right yet,
Yeah.
towards the end of the sale. So if they wanted to redeploy capital into the next deal, it'll be available. So we'll see. I think, to at least acquire another 300 units probably by the end of 2022 is a reasonable goal. But again, that our unit count will go down because we're selling some things, but it'll
Yes.
go up. So we'll see. I'm not really as concerned about that. We're concerned about doing good deals and not just doing deals that don't make sense, but they're bigger unit counts.
Yeah, some people are just buying deals for buying deals. Like you don't buy for the sake of buying. You're buying for profit, various profit centers, pulling your money out, like you said, and reinvesting. That's a huge one. Because if your money sits there and the deal's doing well, of course you put in all that money. So it's like your bank. So that's really cool. And you mentioned exploring different states. Have you looked at other states, or you think there's still opportunities where you're investing already, or?
Yeah, still opportunities where we're investing, and obviously it's good to know where we're investing already. So, but yeah, there's other opportunities in mostly the southeast in the U.S. I've had experience in the Carolinas, had experience in Georgia. There's some other states that I would consider too. So, if we're going to expand to other states, it'll probably be ones that I'm familiar with already and have done business, even if it wasn't for me. Um, already, and then we'll see what happens. But we're in 4 states right now, and we really went out of state with the Florida market
Yeah,
from
that's
where we
far.
are. So we've been able to manage it, and it's been going well. So we're in a good position to expand if we really wanted to.
Cool. And in Florida, I'm curious to ask, where are you investing? Like which cities or areas?
Yeah, we invested in Tampa Bay area, so Clearwater. We have an asset there, and then Orlando. We bought an asset in Orlando recently. Kind of the Orlando MSA. There's a city called Ocala that we really like,
Oh, yes.
which is about an hour, 45 to an hour northwest of Orlando, but it sits between Orlando and Jacksonville and Tallahassee. So it's a really good location, and hasn't really been developed on the housing side. And there's a lot of new companies coming in that are going to demand housing, or at least quality workforce housing, which is what we specialize in. So yes, we really like that market. We have a bunch of deals that we just closed there, and a couple new deals there as well. So hopefully we'll be able to continue to expand there, and then maybe we'll go up a little bit north in Florida as well.
Okay. Yeah, I love the Sunshine State. It's great. And are you, like, as a Canadian, real estate buying in Florida? I'm always concerned about hurricanes. I know it can happen anywhere, but the central Florida, I find, just feels safer. There's fewer hurricanes, or not as bad. Is that something you consider as well? Because New Jersey, I mean, you're not prone to hurricanes or tornadoes too much.
Yeah.
Uh, yeah, or is that something you look at, or?
Yeah, absolutely. I mean, we get all the insurance that would cover any of those types of events anyway. But the properties in Florida that we have are not near the coasts at all.
Yeah.
Even the one in Clearwater that we have is not on the beach. It's before the beach, and it's not near the water. So we do look at that because that is a risk that you do face in a market like Florida. But it's something that we look at. You have to worry about sinkholes too. So
Yeah.
definitely look at that. But again, it comes down to your due diligence and understanding your markets and where the sinkholes are, and where new ones could potentially be formed. But we do all that due diligence before we acquire an asset.
Okay, so a very thorough process before acquiring a property. That's great. Well, thank you so much for sharing about your experience and your background and scaling to 650 units in basically 3 years with partners and syndication. But that's very, very advanced, really interesting stuff. So, Anthony, if somebody wants to invest with you or get a hold of you, what's the best way to reach you?
Yeah, we have a special report on our website. It's called How to Leave Your 9 to 5 Through Financial Independence. So it's just redknightproperties.com. Just it'll pop up, download that, check out. It's a ebook that I put together just for some educational materials, and then it'll have my contact information in that book as well. So if you want to reach out, but regardless, I'm on Anthony Scandariato or Red Knight Properties on LinkedIn, Facebook, Instagram, Twitter, you name it. So you should be able to find us.
Excellent. And that's a hot topic, how to leave your 9 to 5. I know lots of Canadians have cashed in tons of equity in their property and they're investing it in the US. So this could be a very affordable option. Like you said, 50, 100,000 is very manageable for a lot of Canadian investors.
Yeah.
So this could be an interesting opportunity. So once again, thank you so much, and we'll have to reconnect maybe in a year or two and see if you're at 1,000 units or 1,200, 1,300 would be double. There
Yeah.
you go.
Yeah, Francois, this is a pleasure, and thank you so much for having me on your show.
Thank you. Take care.